Hey everyone, welcome back to Building Wealth Today TV. Today we're diving headfirst into the world of investing with an absolute beginner's guide to buying your very first stock. Listen, I remember when I first started out, the whole stock market seemed like this big, scary, complicated thing. I totally get it. But trust me, it's way less intimidating than you might think. And getting started is actually pretty straightforward. So, whether you've got $100 to invest or $10,000, this video is going to break down everything you need to know to start building wealth through the stock market. Let's do this. Before we jump into buying stocks, it's crucial to understand what the stock market actually is. Simply put, it's like a giant online marketplace where you can buy and sell pieces of companies, called stocks. Think of it like owning a tiny slice of your favorite company, like Apple or Tesla. When those companies do well, the value of your slice, your stock, can go up. Of course, just like any market, there are risks involved. The value of your stocks can go down too, but understanding the basics can help you make smarter investment decisions. So let's break down some key concepts to get you comfortable navigating this exciting world. Now, you might be thinking, why should I even bother with the stock market? Well, here's the thing. Investing in the stock market is one of the most powerful ways to build long-term wealth. Think about it. Keeping your money in a savings account might seem safe, but with inflation eating away at your purchasing power, your money is actually losing value over time. The stock market, on the other hand, has historically provided much higher returns than traditional savings accounts, meaning your money has the potential to grow significantly faster. And the sooner you start, even with a small amount, the more time your investments have to compound and grow exponentially. It's like planting a tree. The earlier you do it, the bigger it can grow. You can make money by buying stocks at a low price and selling them when their value increases. Additionally, many companies pay dividends, which are regular payments to shareholders, providing a steady income stream. And don't forget about long-term growth. Holding on to stocks for years can lead to substantial gains as companies grow and expand. By investing in stocks, you can build wealth over time, achieve your financial goals, and secure a comfortable future for yourself and your family. Now, I know what you might be thinking. You're going to show me how to get rich quick, right? Hold your horses. While the stock market offers incredible potential, it's crucial to understand that it's not a get-rich-quick scheme. Investing in the stock market is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Don't expect to double your money overnight. Instead, focus on building a solid foundation of knowledge and making informed decisions based on your financial goals. Like any investment, the stock market comes with risks. The value of your investments can fluctuate, and there's always the possibility of losing money. However, the level of risk you take can often be managed by diversifying your investments and investing for the long haul. Remember, the stock market has historically trended upwards over the long term, and by staying invested and riding out the inevitable dips, you're more likely to come out ahead. So, understand the risks, but don't let them paralyze you. Knowledge and a sound strategy are your best allies in the stock market. By understanding risk versus reward, diversifying your investments, and leveraging the power of compounding returns, you can make money in the stock market. All right, ready to dive into actually buying stocks? The first step is to open a brokerage account. Think of a brokerage account like your online portal to the stock market. It's where you'll deposit money, research stocks, and place your trades. Choosing the right brokerage is important, so let's talk about some key factors to consider. Now, there are tons of brokerages out there, each with its own set of features, fees, and investment options. Some popular options include Fidelity, Schwab, and Vanguard, known for their low fees and comprehensive research tools. If you're more of a hands-off investor, you might consider robo-advisors like Betterment or Wealthfront, which automate your investments based on your risk tolerance. Do your research, compare fees, and choose a platform that aligns with your investing style and goals. Opening a brokerage account is usually a quick and straightforward process. You'll need to provide some basic personal information, like your social security number and employment status. Don't worry, it's all secure and confidential. Once you've submitted your application, it typically takes just a few business days for your account to be approved and ready to go. It's like opening any online account, just with a little more financial information involved. With your brokerage account set up, it's time to deposit some funds so you can start investing. Most brokerages allow you to link your bank account for easy electronic transfers. Remember, only invest money you can afford to lose. Start small and gradually increase your investment amount as you gain more experience and confidence. All right, so you've got your brokerage account set up. That's a huge step. But before you even think about dropping money on that hot stock tip your buddy gave you, listen up. You wouldn't buy a car without checking its mileage, features, maybe even kicking the tires a bit, right? Same goes for stocks. Investing without research is like playing darts blindfolded. You might get lucky, but chances are you're going to miss the target completely. We're talking about your hard-earned money here, people. Every dollar you invest represents a piece of your future freedom. You've got to treat it with respect. That means doing your due diligence, understanding what you're buying, and why you're buying it. That's what this research thing is all about. Gaining knowledge to make informed decisions, minimizing risk, and setting yourself up for success in the long run. Trust me, a little effort up front can make a world of difference down the line. Now, when it comes to researching stocks, there are two main approaches: fundamental analysis and technical analysis. Let's start with the fundamentals. Think of this like checking under the hood of a car before you buy it. Fundamental analysis is all about digging into a company's financial health and performance. You're looking at things like revenue, earnings, debt levels, cash flow, basically how well the business is actually doing. Are they making money? Are their sales growing? Do they have a mountain of debt they're struggling to pay off? These are crucial questions to ask. You want to invest in companies with a solid track record and strong future prospects, not ones that are about to go belly up. Luckily, there are tons of resources out there to help with this. Websites like Yahoo Finance, Google Finance, and even your brokerage account will have detailed financial information on publicly traded companies. Get familiar with these tools, learn to read financial statements, and start digging into the numbers. All right, so we've covered the fundamentals, looking at a company's financial health. But there's another layer to stock research technical analysis. Now, instead of popping the hood, we're looking at the car's navigation system, trying to anticipate its future path. Technical analysis is all about studying charts and patterns in a stock's price and trading volume. The idea is that historical price movements can give you clues about where the stock might be headed in the future. Now, let me be clear, I'm not talking about some crystal ball here. Technical analysis isn't about predicting the future with 100% certainty. Nobody can do that. But it can help you identify trends, spot potential buying or selling opportunities, and manage your risk more effectively. You'll come across things like moving averages, MACD, RSI. These are all technical indicators that traders use to analyze price action. Don't get overwhelmed by the jargon. There are tons of resources available to help you learn about these indicators and how to use them. So we've covered fundamental analysis, which is like examining a company's engine, and technical analysis, which is like studying its navigation system. Now, here's the key. You don't have to choose just one. In fact, the most successful investors use a combination of both fundamental and technical analysis. They look at the company's financials, its management team, its competitive landscape, all that good stuff. But they also pay attention to chart patterns, trading volume, and market sentiment. It's like having a toolbox full of tools. You wouldn't use a hammer for every job, right? Same goes for stock research. The best approach is to use a blend of methods that you're comfortable with and that align with your investment goals. Remember, knowledge is power. The more you understand about the companies you're investing in and the factors that can influence their stock prices, the better equipped you'll be to make smart, informed decisions with your money. All right, so you've done your research, you've opened your brokerage account, and you've got your eyes set on a particular stock. Now it's time to actually buy the stock, and to do that, you need to place a trade. Now this might seem intimidating at first, but trust me, it's way easier than you think, especially with these modern trading platforms. The first thing you need to understand is the different types of orders you can place. The most common type is a market order, which basically tells your broker, hey, buy this stock at the best available price right now. This is the simplest and fastest way to buy a stock. Then you have limit orders. With a limit order, you're setting a specific price that you're willing to buy the stock at. So let's say a stock is trading at $50, but you only want to buy it if it drops to $48. You can place a limit order for $48, and the trade will only execute if the stock hits that price. Limit orders give you more control over the price you pay. There are other order types like stop-loss orders and trailing stop orders that are more advanced. But for beginners, sticking with market orders and limit orders is perfectly fine. Remember, you don't need to be a Wall Street wizard to get started. Once you've chosen your order type, the next thing to decide is how many shares you want to buy. Now, this depends on a couple of factors, the most important being how much money you're willing to invest. Remember, never invest more than you can afford to lose, and it's always a good idea to start small and gradually increase your investment over time. Let's say you've decided to allocate $1,000 to this particular stock. If the stock is trading at $50 per share, you can buy 20 shares with your $1,000. It's that simple. Now, some brokers offer fractional shares, which means you can buy a portion of a share if you can't afford a full share. This is great for beginners or those who want to invest in expensive stocks without dropping a ton of money up front. For example, if a stock like Amazon is trading at $3,000 per share, with fractional shares, you can buy, say, $500 worth of Amazon stock, even though you can't afford a full share. The key here is to start small, diversify your portfolio, and gradually increase your investment as you gain more experience and confidence in the market. Remember, investing is a marathon, not a sprint, and slow and steady growth is the key to long-term success. Okay, you've chosen your order type, decided how many shares or fractional shares you want to buy. Now it's time to review and submit your order. This is a crucial step, so don't just rush through it. Double-check the stock symbol, the number of shares, and the order type to make sure everything is correct. Most brokerage platforms will show you the estimated total cost of your order, including any commissions or fees. Remember, even though many brokers offer commission-free trading these days, there might be other fees involved, so it's essential to be aware of those before you hit the submit button. Once you're happy with everything, take a deep breath and click that Place Order or Confirm Trade button. Congratulations, you've just placed your first stock trade. You're officially an investor, and you've taken the first step towards building long-term wealth through the power of the stock market. It's important to remember that your order might not be filled immediately, especially if you've placed a limit order. It might take some time for the stock price to reach your desired level. Be patient and don't panic if your order isn't filled instantly. The market moves at its own pace. After you've placed your order, you'll receive a confirmation, usually via email or through your brokerage app, with all the details of your trade. This confirmation will include the stock symbol, the number of shares, the price at which your order was filled, and any applicable commissions or fees. It's essential to keep these confirmations for your records, especially for tax purposes. Remember, when you sell your stocks, you'll need to report any capital gains or losses on your tax return. Now that you've bought your first stock, what next? Well, investing is not a set it and forget it kind of thing. You need to monitor your investments, keep up with the companies you're invested in, and make adjustments to your portfolio as needed. Next, we'll dive deep into how to monitor and manage your investments like a pro, so you can maximize your returns and build a portfolio that aligns with your financial goals. Stick around, we've got a lot more to cover. Congratulations! You've officially dipped your toes into the stock market and made your first investment. But the journey doesn't stop there. Now comes the important part, keeping a watchful eye on your investments and managing your portfolio like a pro. Remember, this isn't a get-rich-quick scheme. It's about long-term growth and making informed decisions. The first step to effective portfolio management is regularly tracking your investments. This doesn't mean obsessively checking your portfolio every 5 minutes. In fact, that can do more harm than good, leading to emotional decisions based on short-term market fluctuations. Instead, aim for a balanced approach. Set aside some time each week or month, whatever suits your schedule and risk tolerance, to review your portfolio's performance. Most brokerage platforms offer user-friendly tools and charts that make it easy to monitor your holdings. You can see at a glance how your individual stocks are performing, as well as your overall portfolio growth. Remember, the key here is to focus on the long-term trend, not short-term market noise. The stock market is inherently volatile, with ups and downs being a natural part of the game. Don't panic if your portfolio dips in the short term. What matters most is its overall trajectory and how well it aligns with your long-term financial goals. As your investments grow and the market fluctuates, your portfolio's asset allocation, the percentage of your money invested in different asset classes like stocks, bonds, or real estate, can drift away from your original plan. That's where rebalancing comes in. Rebalancing is the process of adjusting your portfolio to maintain your desired asset allocation. Let's say you started with a portfolio of 80% stocks and 20% bonds. After a year, your stocks might have performed exceptionally well, shifting your allocation to 90% stocks and 10% bonds. This means you're now overexposed to the stock market's volatility. To rebalance, you would sell some of your stock holdings and buy more bonds to bring your portfolio back to the original 80-20 allocation. This disciplined approach helps manage risk and ensures your portfolio stays aligned with your long-term financial goals. Remember, rebalancing isn't about timing the market. It's about maintaining a consistent investment strategy. It's like regularly tuning up your car. It keeps your investments running smoothly and efficiently over the long haul. And there you have it. You've just learned the fundamentals of investing in the stock market, from understanding how it works to researching stocks, opening a brokerage account, placing your first trade, and even managing your investment like a pro. Remember, investing is a journey, not a destination. It's about making smart, informed decisions that align with your financial goals and risk tolerance. Thanks for watching. If you found this video helpful, make sure to hit that like button and subscribe for more investing tips and tricks. Leave a comment below if you have any questions or topics you'd like us to cover next. Until then, happy investing and thanks for watching Building Wealth Today TV.